Simulation 2, Capital Structure Part 2. John Smith is a senior manager at Crane Investments who is considering both Vetter Company and Deep Mining Incorporated for inclusion in the company's blended mutual fund portfolio. To complete his analysis, he needs information regarding Vetter's capital structure, financial statements for Deep Mining, and overall financial leverage data on the mining industry. Use of information contained in the exhibits. There are 5 exhibits for part 1 to 3 below. The information in the analytics definition exhibit must be used for all financial ratio calculations. First part says calculate the weighted average cost of capital for Vetter Company. So which exhibit to open? Deep Mining, not interested. Analytics definition, the formulas that we should use for computation. Extract of report on mining industry, not the concern at the moment, which means what we are looking for is most probably present here in email correspondence. So let us see what do we have in this conversation. Hello John, you had asked me earlier in the week to look at debt and equity cost of capital that could apply for our analysis of Vetter Company as well as Vetter's overall capital structure. Regarding the debt side, Vetter's pre-tax cost of debt is 7%. Let me highlight what we might need for our computations. Okay. We need this cost of debt is an important information highlighted. It also has outstanding preferred stock which carries a cost of 7.5. Great, we have what we need. The tax rate that we should use is 40%. For equity, I think it is best to use return on S&P index 7.5% as your market return. That is the return on the market. This is important piece of information. Because Vetter has shown considerable volatility relative to the overall market for the last few years. So I suggest a beta of 1.2 for the CAPM computation. Finally, with the interest rates going up, I think we can be comfortable using a risk-free rate of 4.0%. That is the RF to be used in CAPM computation. Using Vetter's year's 5 balance sheet, 50% of its capital structure is on liability. 50% is liability. Please mark this down. That is the debt, 50% debt, 10% on preferred stock. Let's highlight that as well. And finally, 40% in common equity. That's the proportion we will use in the weighted average cost computation. So let us do the computations now. First thing first, cost of debt. Right here, cost of debt is equal to the percentage given times 1 minus tax. Remember, cost of debt must be taken on after tax basis. So it's going to be 4.2%. First thing first. Then the next thing we can calculate is right here is the cost of preferred stock. I'm going to write it as KPS. So KPS is given as 7.5. No working required. Straightforward. Then the third part involves the calculation of cost of equity. For this we have been given all the inputs to the CAPM model. RF plus beta into RM minus RF. RF is the risk-free rate, that is 4%. Beta is given as 1.2. We have already highlighted for this purpose. Into the return on the market, that is, interestingly, the cost of preferred stock is 7.5 and 7.5 is the return on the market. So, interesting, they were saying otherwise we would have made the mistake. So, this is the return on the market and they happen to be the same. Anyways, 7.5 minus the risk-free rate is 4%. If you simplify this, you are going to get 7.5 less 4, 2.5, 1.4. So it's going to be 4.2 plus 4, so it's going to be 8.2%. So we have got all cost of equity, cost of preferred stock, and the cost of debt. Now what we have are these proportions: 50% of debt at the rate of 4.2% plus 10% of preferred stock at the rate of 7.5% cost, and lastly 40% equity at the rate of 8.2%. So what I'm going to do, I'm going to calculate the weighted average now. 50% of my funds have come at a cost of 4.2, done. Then 10% of my funds have come at a cost of 7.5, done. And lastly, 40% of my funds have come at the cost of 8.2. So that gives me a total value of 6.13%. That's my weighted average cost of capital, and that's what I'm going to plug it in this place. 6.13%. 0.13%. Alright, so the next part 2 says calculate the following ratios for Deep Mining Incorporated for year 5. The leverage ratio for Deep Mining is first debt to equity. Remember, we have been given a special exhibit containing the analytics definition. The formulas used in this exhibit are to be used by you for the computation purpose. So this is the one we are going to use. Debt to equity is total liabilities upon total equity. And for the next part, total debt ratio, we know total debt ratio is the total debt upon total asset. We should have it here as well. See right here, total debt ratio is total liabilities or total debt upon total assets. So we are going to apply these ratios to find our answer. Deep Mining year 5. Okay, this is the balance sheet for Deep Mining, and this is what we are interested in. This is the total debt side here. 290 accounts payable, salaries payable, current maturities of long-term debt and long-term debt. All the current and non-current debt to be taken. All this. If you add this 290.5 plus 3.5 plus 128 plus 700, it gives you total debt of 1122. To be divided with equity, because we debt to equity, equity is given right here, 918. So pretty straightforward. So if you simplify 1122 divided by 912, you get 1.2222 or simply 122.22%. So just plug it in. Let's see in what form is the answer required. So let us write it in percentage, 12.2%. Now go for next one, the total debt ratio, that is total debt to total assets. Okay, so this is the figure for total assets. This is we previously calculated as a figure for total debt, including this 700,000. Remember all this. So this was 1122, the total debt. Remember the formula for total debt ratio: total debt, total liabilities upon total assets. And these are our total assets, 2040. If you simplify, it's going to be 0.55 exact. And when you convert it to percentage, it's going to be 55%. And that's what you're going to plug in this location, 55%. Done. Next is time interest earned, and we know the formula to calculate the time interest earned, that is EBIT upon interest expense. But let us just check the analytics definition. Income before interest expense and taxes upon interest expense, or simply EBIT upon interest expense. So that's exactly what we're going to do. Remember, this is the balance sheet, this is the income statement, and we have these numbers available in the income statement. So we need operating income, 412, right? And simply divide it with the interest expense. Khalas. So what you're going to do, divide 412.5 with 67.5, and if you do, what you should get, 412.5 upon 67.5 gives you 6.11 times, remember. So just plug it in and move on. 6.11. All right, next. Last part says select from the option list how Deep Mining Incorporated leverage compares with that of the mining industry as a whole. How does Deep Mining Incorporated's financial leverage compare with the industry average? So for this, we have to go for the extract, where we have the relevant information right given at this. Profitability you are not interested in, leverage is what we are interested in. Now debt to equity ratio for the industry is 91.6%, but I hope you remember, you can just scroll up and see our number was 122.2%. Then times interest, and we just calculated it 6.11 times. And lastly, the total debt ratio. The total debt ratio was 55%. We just calculated a little while ago. So as you can see, these numbers show that our debt to equity ratio is higher than the industry average. Our total debt ratio, again, it is higher than the industry average. And even our times interest earned is lower, and lower is bad. So in all these three counts, we are not failing well. So all these three comparisons tell us that mining company has higher financial leverage. So now we can just give our response and close this simulation. More leverage than the industry. This is the right option. And you are done.